Imagine this. You wake up one day, check your bank account, and realize your money has been sitting there doing nothing while inflation quietly eats away at it. Scary, right? What if I told you there's a way to put your money to work, even while you sleep, and you don't need to be a stock market expert to do it? That's exactly what mutual funds can do for you. Today, I'm breaking down step by step how to start investing in mutual funds, even if you know absolutely nothing about investing. Stick with me, because by the end, you'll not only know how to start, but also how to avoid the mistakes most beginners make. Number 1. What exactly is a mutual fund? Think of a mutual fund like a big basket. Inside this basket are many different investments, stocks, bonds, or even a mix of both. Instead of buying one stock, you buy a piece of the whole basket. The cool part is that this basket is managed by professional fund managers who do the hard work of picking investments for you. For example, instead of trying to guess if Apple or Amazon will perform better, you can invest in a mutual fund that owns both, along with hundreds of other companies. This spreads out your risk and makes it easier for beginners. Number 2. Why should you invest in mutual funds? Let's be honest. Most beginners don't have the time or skills to research individual stocks. Mutual funds solve that problem. They give you instant diversification. If one company in the fund performs badly, others may perform well, balancing things out. According to data from the Investment Company Institute, nearly 116 million Americans already invest in mutual funds, making them one of the most popular ways to grow wealth. Here's another benefit. Many mutual funds allow you to start with as little as $500, making them accessible even if you don't have a lot of money. Imagine putting away $100 each month into a mutual fund. Over years, thanks to compounding, that small habit could grow into tens of thousands of dollars. Number 3. The different types of mutual funds you should know about. This is where things get interesting. Not all mutual funds are the same. Some are stock funds that invest in companies. Others are bond funds that lend money to governments or corporations. Then you have balanced funds that do both. An example, a stock fund might focus on big companies like Microsoft or Coca-Cola, while a bond fund might invest in USA Treasury bonds. Stock funds usually offer higher returns, but are riskier. Bond funds are safer, but often give lower returns. Balanced funds are like the middle ground. Knowing the difference helps you pick the one that matches your goals and comfort with risk. Number 4. How much money do you really need to start? Here's the good news. You don't need to be rich. Many mutual funds let you start with $500 to $1,000. Some even allow you to start with less if you agree to set up automatic monthly contributions, like $50 or $100 a month. Think about it this way. Skipping one dinner out per week could give you enough to start investing. Over time, those small amounts can build serious wealth. For example, if you invest $100 every month in a mutual fund that averages 8% annual return, in 30 years you could have over $140,000. That's the power of consistency and compounding. Number 5. The step-by-step process to start investing today. Step 1. Set your goal. Are you investing for retirement, a house, or just to grow wealth? Your goal will shape your choices. Step 2. Choose the right account. Most beginners use a brokerage account or a retirement account, like a 401k or an IRA. A 401k is usually offered by your employer, while you can open an IRA or brokerage account on your own. Step 3. Pick a mutual fund. Look at factors like risk level, fees, and past performance. Don't just chase the highest returns. A consistent, low-cost fund often beats flashy funds in the long run. Step 4. Decide how much to invest. Start small and increase as you get more comfortable. Step 5. Set up automatic contributions. Automation is the secret weapon. It ensures you keep investing even when life gets busy. For example, Sarah, a beginner, set up an automatic $200 monthly contribution to a balanced mutual fund through her IRA. 10 years later, she had over $35,000 saved without even thinking about it. Number 6. Fees matter more than you think. Here's something many beginners overlook: fees. Mutual funds charge something called an expense ratio. This is the percentage of your money that goes to managing the fund. A fund with a 1% fee might not sound like much, but over decades, that can cost you tens of thousands of dollars. For example, if you invest $10,000 in a fund that grows at 8% per year but charges 1% in fees, after 30 years you'll have about $574,000. But if the fee was just 0.1%, you'd have around $672,000. That's almost $100,000 difference. Always compare fees before choosing a fund. Number 7. Should you pick actively managed or index mutual funds? This is a big decision. Actively managed funds have managers trying to beat the market by picking winning investments. Index funds simply copy a market index, like the S&P 500, which includes 500 of the biggest USA companies. Studies show that over long periods, index funds often outperform most actively managed funds because of lower fees and more consistent performance. For example, if you had invested in an S&P 500 index fund 30 years ago, you'd have seen your money grow over 10 times, even with all the market ups and downs. That's why legendary investor Warren Buffett recommends index funds for most beginners. Number 8. How risky are mutual funds really? Here's the truth. Mutual funds are not risk-free. If the stock market goes down, your stock mutual funds will go down too. But compared to buying a single stock, they're much safer because you're diversified. The key is to match the fund to your risk tolerance and time horizon. If you need the money in a few years, stick with safer bond funds. If you're investing for retirement 30 years from now, stock funds make sense. For example, if you invest in a growth stock mutual fund, expect bigger swings in value. But if you invest in a bond fund, the ride will be much smoother, though the returns may be lower. Number 9. The tax side of mutual funds you should know about? Yes, Uncle Sam wants his cut. Mutual funds can generate taxable income through dividends, interest, and capital gains. If you hold your fund in a regular brokerage account, you'll pay taxes on those gains each year. But if you invest through a retirement account, like an IRA or 401k, you can defer taxes until you withdraw in retirement, or even invest in Roth accounts where your withdrawals are tax-free. For example, John invests in a mutual fund inside his Roth IRA. He never pays taxes on his growth as long as he follows the rules. That's a huge advantage. Number 10. Mistakes beginners must avoid. Mistake 1. Investing without a goal. You need to know why you're investing. Mistake 2. Chasing last year's top-performing fund. Just because it did well last year doesn't mean it will this year. Mistake 3. Ignoring fees. We've already seen how damaging they can be. Mistake 4. Panicking when the market drops. Mutual funds are long-term investments. The market always has ups and downs. If you pull your money out too quickly, you lock in your losses. Here's a story. In 2008, during the financial crisis, the stock market dropped nearly 40%. Many investors sold in fear. But those who stayed invested saw their funds recover and even grow in the years after. Patience pays. Number 11. How to track your progress and stay motivated. Once you invest, don't just forget about it. Review your funds once or twice a year to make sure they still align with your goals. Most brokers give you online dashboards showing how your investments are performing. You can even use apps to track your progress. For example, imagine watching your balance grow from $1,000 to $2,000 to $5,000 over the years. That progress is motivating and encourages you to keep going. But don't overcheck. Daily ups and downs can drive you crazy. Remember, this is a marathon, not a sprint. Number 12. The power of compounding. Why starting early matters. Albert Einstein supposedly called compounding the eighth wonder of the world. Here's why. If you invest $5,000 today and let it grow at 8% per year, in 30 years it becomes over $50,000. But if you wait 10 years before starting, you'll end up with only about $23,000. The earlier you start, the bigger the snowball effect. That's why even small amounts invested in your 20s or 30s can make a massive difference by retirement. Imagine planting a tree. The sooner you plant it, the bigger and stronger it grows. Number 13. Putting it all together, your action plan. By now you know what mutual funds are, why they're powerful, and how to get started. So here's your action plan. First, set your goal. Second, open the right account. Third, pick a low-fee mutual fund that matches your goal and risk level. Fourth, automate your contributions. And fifth, review once a year and stay consistent. Follow this simple path, and you'll be miles ahead of most beginners who never take action. The hardest part is just starting. Once you start, the rest becomes routine. Number 14. How to choose between growth and income mutual funds. Growth funds focus on companies that are expected to grow quickly, like tech startups or innovative businesses. They usually reinvest profits instead of paying dividends, so you make money mainly through rising share prices. Income funds, on the other hand, focus on stable companies or bonds that pay dividends or interest. They're great if you want regular income. For example, if you're in your 20s and saving for retirement, a growth fund makes sense. But if you're in your 60s and want steady payouts, an income fund could be a better choice. Number 15. What is a target date mutual fund, and should you try it? A target date fund is designed for people saving for retirement. You choose a fund based on the year you plan to retire, like a 2050 fund. The fund automatically adjusts its investments over time. When you're young, it holds more stocks for growth. As you get closer to retirement, it shifts into bonds for safety. For example, Emily invests in a 2060 target date fund at age 25 in her 20s and 30s. The fund takes more risk for higher growth. By the time she's nearing retirement, it becomes much more conservative without Emily needing to lift a finger. Number 16. What are load and no-load funds? Some mutual funds charge a sales commission called a load. You might pay it when you buy the fund, a front-end load, or when you sell it, a back-end load. No-load funds skip these commissions, which makes them cheaper and friendlier for beginners. For instance, if you invest $1,000 in a fund with a 5% front-end load, you instantly lose $50 to fees before your money even starts working. Choosing a no-load fund keeps that money in your pocket. Number 17. Should you reinvest dividends or take cash payouts? Many mutual funds give you the option to reinvest your dividends or take them as cash. Reinvesting means your dividends automatically buy more shares, which helps your money grow faster through compounding. Taking cash might make sense if you rely on that income, like in retirement. For example, if your fund pays you $200 in dividends and you reinvest it, that money keeps compounding for years. Over decades, reinvesting could mean thousands of extra dollars in your account. Number 18. How mutual funds compare to ETFs. ETFs, or exchange-traded funds, are like cousins of mutual funds. They also hold a basket of investments but trade like a stock on an exchange. ETFs often have lower fees and can be bought or sold throughout the day. Mutual funds, on the other hand, are priced once a day. For beginners, mutual funds are simpler to set up with automatic contributions, while ETFs give more flexibility for active traders. For example, you could invest in an S&P 500 mutual fund or an S&P 500 ETF. Both give you exposure to the same companies, but the ETF might have slightly lower costs. Number 19. How to decide between taxable and retirement accounts for mutual funds. If you invest in a regular taxable brokerage account, you'll pay taxes on dividends and capital gains every year. If you use retirement accounts like an IRA or 401k, you can delay or even avoid those taxes. For instance, if you invest in a mutual fund inside a Roth IRA, your gains grow tax-free. But if the same fund sits in a taxable account, you'll pay taxes every year on distributions. For beginners, retirement accounts often make the most sense because of these tax advantages. So now let me ask you, if your future self could come back 20 years from now, would they thank you for starting today? Or would they be disappointed that you waited too long? What type of mutual fund are you most interested in trying first? Stock, bond, or index?